Welcome to the Explainer. Today, we are diving into a really fascinating paper called Covering the World. And let me tell you, it's got a pretty surprising warning about one of the most popular investment strategies on the planet. So let me just start with this question for you. What if a strategy that everyone tells you is safer was actually hiding a major risk? A risk you weren't even getting paid to take? Well, that's exactly the mystery we're going to solve today. All right, so the strategy we're talking about is called a covered call. The concept itself sounds pretty simple, right? You own a stock, say 100 shares of something, then you sell someone else the right to buy that stock from you later at a higher price, and for giving them that right, they pay you a fee called a premium. It's kind of like you're renting out your stock's future potential for a little extra cash in your pocket right now. And the sales pitch for this is just incredibly appealing. The whole idea is that you get returns that are pretty similar to just holding the stock, but with a much, much smoother ride. Fewer of those heart-stopping drops. Because that premium you collect acts like a nice little cushion. And hey, this isn't just some theory. The numbers really seem to back it up. When you look at the data, on average, across 11 different global stock indexes, just owning stocks had a volatility over 21%. But you run a covered call strategy on top, that drops all the way down to under 15%. That is a massive reduction in risk. Seems like a no-brainer, right? But this is where it gets interesting. The authors of this paper, Israelov, Klein, and Tumala, they decided to pop the hood and see what was really going on. They asked, is this simple story of collecting rent the whole story? Or is there something else happening here that most investors are completely missing? So they broke the covered call down into its three true economic pieces. First, you've got your passive equity. That's simple. That's just you owning the stock. Second, you've got your short volatility exposure. That's the income you get from selling that option. But then they found this third kind of hidden component. They called it dynamic equity exposure. And this thing is a little tricky. It's a risk that pops up because as the market zigs and zags, your actual exposure to the market is constantly changing. And often, it's changing in a way that actually works against you. So this leads to the million-dollar question, right? You've got these three parts. How much is each one actually contributing to your bottom line? Are they all pulling their own weight? And boom, here is the first major shocker from the paper. When the researchers looked at where the returns were coming from, the passive equity part and the short volatility part both gave you a positive return. But that third piece, that sneaky dynamic equity, on average, its return was zero. A big, fat nothing. It added absolutely nothing to your wallet over time. Okay, so hold on. It gets worse. Now we look at the risk side of the equation. And that same dynamic equity part, the one that gave you zero return, was actually a huge source of your risk. Get this, it was more than twice as volatile as the short volatility part, which was the piece that was actually paying you. You don't have to take my word for it. The authors say it perfectly themselves in the paper, and I quote, "The returns from the equity timing exposure are statistically insignificant in all 11 indexes, yet this exposure contributes a relatively large amount of the strategy's risk." That's not some tiny little flaw. That is a fundamental problem with a strategy as it's typically practiced. So let's just call it what it is. This dynamic equity piece is what we call an uncompensated risk. It means you are taking on a whole lot of turbulence, a whole lot of volatility for literally no expected reward. It's all risk and no return. And that, of course, leads to a beautifully simple, almost obvious question. If you find a part of your investment that's giving you all the headaches and none of the profits, what if you could just get rid of it? Well, that's exactly what the researchers did. They engineered a risk-managed version of the strategy designed specifically to cancel out that useless dynamic equity risk. And the results, they are absolutely stunning. Look at this. Volatility drops. The worst-case loss, the max drawdown, improves from a scary -44% to a much more manageable -35%. And the Sharpe ratio, which is a key measure of your return for every unit of risk you take, it jumps from 0.35 all the way up to 0.51. Let's just focus on that Sharpe ratio for a second. An improvement of 0.16 is a huge deal in the investing world.
It's not a tiny tweak, it's a massive improvement in the efficiency of the strategy. You're getting so much more bang for your risk-taking buck just by getting rid of the part that wasn't paying you anyway. Now, I know what you might be thinking. Okay, great, but that's probably just a quirk of the US market, right? Nope, not at all. There's a reason the paper is called Covering the World. They ran these tests across 11 major global stock indexes. We're talking everything from the S&P 500 to the Nikkei in Japan, the DAX in Germany, and they found the exact same thing everywhere. This is a global phenomenon. And believe it or not, it gets even better. Because when you take all these newly improved risk-managed strategies from around the world and you combine them into one big global portfolio, the magic of diversification kicks in. The overall volatility of the whole thing drops again down to just 9.7%, and the Sharpe ratio gets another nice little bump up to 0.57. So what is the bottom line here for all of us? Well, first, it's a huge reminder that even the most popular strategies, the ones sold as safe, can have some serious hidden flaws. Second, it's absolutely crucial to look under the hood and understand where your risks and returns are really coming from. And third, in this case, simply hedging away that dynamic equity risk, the one that wasn't paying you, dramatically improves the strategy. And if you go one step further and diversify that improved strategy globally, the advantage gets even bigger. So we'll end with this thought. In a way, these researchers found what investors are always looking for: a free lunch. They didn't add anything new. They just got rid of a risk that wasn't paying them. And it makes you wonder, doesn't it? Where else in your portfolio, or maybe even in your life, are you taking on these uncompensated risks? What could you achieve if you only focused on the things that truly rewards you? Thanks for joining us for The Explainer.